The US government's credit rating, a bedrock of global finance, was suddenly downgraded in August, a move that sent shockwaves through financial markets. This unprecedented decision by Fitch, a major ratings agency, cited the nation's escalating debt burden and a perceived lack of effective governance. This alarming assessment begs a critical question: how can the world's largest debtor, the United States government, navigate a financial landscape where its fiscal responsibility is openly questioned, and what will be the ultimate price? We will delve into the surprising truth that, despite these dire warnings, the US can theoretically borrow an unlimited sum of money without ever defaulting. The dramatic surge in interest rates over the last few years has ignited widespread economic anxiety. Individuals, businesses, and financial institutions alike now face significantly higher costs on their outstanding liabilities, which have ballooned since the onset of the global health crisis. Yet, what about the world's single largest borrower, the United States government? Over the past 2 decades, the federal debt has soared, reaching an astounding $33 trillion. In 2023, the government anticipated spending $640 billion merely to service this debt. However, as existing debt is refinanced at elevated interest rates, this figure is projected to skyrocket to $1.3 trillion, consuming over a quarter of all federal tax revenue. Despite the seemingly perilous budgetary outlook, the government has shown no inclination to curb its spending pace, with the annual budget deficit expected to remain well above $1 trillion for the foreseeable future. The situation reached such a critical point that in August, the credit rating agency Fitch lowered the US government's credit rating, explicitly pointing to the escalating debt and a general lack of competent leadership. These figures paint a grim picture, with the national debt translating to $300,000 for every household in the country. As this debt continues to expand, this financial load will increasingly fall upon future generations. However, this perspective is not universally shared. According to former Federal Reserve Chairman Alan Greenspan, the United States will never fail to meet its debt obligations because it always possesses the power to create more money. This assertion sounds almost too good to be true. Does the government truly possess an endless line of credit, allowing it to accumulate trillion-dollar deficits without consequence? While interest rates remain elevated, the government is still striving to secure funding. The complexities of economic policy and national debt can appear daunting, yet they are grounded in systems governed by clear rules and quantifiable metrics, much like the STEM disciplines. To confidently navigate our future, whether by comprehending the economy, engineering the next major technological breakthrough, or simply making more informed choices, it is crucial to sharpen our analytical skills in these vital areas. Fortunately, the most effective way to achieve this does not require immense financial investment or years of academic study. It is, in fact, both free and readily accessible. Brilliant stands out as an exceptional platform for mastering mathematics, data science, and computer science. Its approach is engaging and interactive, offering thousands of lessons from foundational concepts to advanced topics, with new content added monthly. I have particularly appreciated their How Technology Works courses, which elucidate the functioning of electronic components like transistors and capacitors. It also imparts practical knowledge, such as why certain passwords offer greater resistance to cyber attacks than others. Many technologies we rely on daily often feel like impenetrable black boxes, their inner workings a mystery. However, with Brilliant, you can begin to grasp these fundamental mechanisms. The interactive learning methodology Brilliant employs is demonstrably 6 times more effective than passive approaches, such as watching lecture videos. This means you can master complex subjects in as little as 15 minutes per day. To explore everything Brilliant has to offer, completely free for 30 days, visit brilliant.org/wallstreetmillennial or click the link in the description. The first 200 individuals to sign up will also receive a 20% discount on Brilliant's annual premium subscription. A recent debt forecast sparked considerable alarm among financial commentators and political figures. The House Budget Committee issued a stark declaration, stating that each household's share of the national debt is projected to reach an astonishing $1 million by the year 2053. $1 million seems an unfathomable sum for an average household, but what precisely does this signify, and how have we arrived at this juncture? The most common method for evaluating government debt is to express it as a percentage of gross domestic product, GDP. The government generates revenue through taxation, consequently, a larger economy renders any given debt load more manageable. The budget deficit represents the disparity between the government's expenditures and its total income. For nearly a century, the budget has almost consistently been in deficit. During the Second World War, specifically in 2004, the deficit swelled dramatically as the government borrowed extensively to finance the war effort, while tax revenues simultaneously declined due to the contraction of the private sector. For several subsequent decades, the budget largely remained in equilibrium, with only minor deficits in most years. Despite this, the debt-to-GDP ratio steadily decreased as economic expansion outpaced the accumulation of new debt. In the decades following the Second World War, the debt-to-GDP ratio remained relatively stable. It wasn't until the 2008 financial crisis that we witnessed a significant surge, as the government invested heavily in unemployment insurance and various stimulus programs. In 2020, the debt level again skyrocketed due to the unprecedented scope and scale of COVID-related economic stimulus measures. A clear pattern emerges: debt levels tend to escalate during periods of crisis, whether it be World War II, the global financial crisis, or the recent pandemic. What has fundamentally shifted recently is that even with the pandemic largely behind us, the government has continued to accumulate what appear to be excessive deficits. Furthermore, with interest rates on the rise, financing these deficits will become increasingly costly. The Congressional Budget Office anticipates the deficit to grow from approximately 5% of GDP in 2023 to 10% of GDP over the next few decades, with the bulk of this increase stemming from higher interest expenses. The total government debt is projected to climb from 100% of GDP today to nearly 200% by 2050. Critics of deficit spending contend that we are currently living beyond our means and that an eventual reckoning is inevitable. Observing the debt clock tick upward, $1 trillion at a time, is viscerally unsettling, and it seems to suggest that at some point, we will be forced to pay for our fiscal irresponsibility, with interest. For decades, politicians have exploited this fear to attack their adversaries, claiming that the opposing party's policies are driving the nation toward financial ruin. Yet, irrespective of political affiliation, each of the past 4 presidents has borrowed more money than their predecessor, and a debt crisis has yet to materialize. Charts like these certainly look alarming, suggesting that America is recklessly hurtling toward a self-inflicted disaster. However, as we will demonstrate, taken out of context, figures such as debt-to-GDP can be virtually meaningless, and America's government debt situation is far less dire than some television pundits might lead you to believe. The projected increase in the deficit over the coming decades is primarily driven by elevated interest expenses. As the overall debt level expands, the amount of money the government must allocate to service the debt grows proportionally. So, where will these funds originate? They will come from the issuance of even more bonds, further accelerating the rate of debt accumulation. On the surface, this presents a formidable challenge. It sounds inherently unsustainable. Consider personal credit card debt. If you borrow additional funds to cover your interest payments, your debt will eventually reach its limit, and your card will cease to function. A similar dynamic applies to corporations. They might issue more bonds to pay interest on existing ones, but as their debt burden grows, their credit rating will decline, prompting investors to demand higher interest rates for newly issued bonds. Ultimately, the company's creditworthiness will deteriorate to such an extent that no one will be willing to lend them more money, regardless of the interest rate. At this juncture, the game is over. Without the cash to meet their interest obligations, they face bankruptcy. The government also issues bonds. For the government to face bankruptcy, it would need to find itself in a situation where no one is willing to purchase its bonds. However, this will never occur. Should all other options fail, the Federal Reserve always stands ready, capable of purchasing any quantity of bonds the Treasury wishes to sell. And since the Federal Reserve possesses a printing press, it can never exhaust its supply of money. This is precisely why Alan Greenspan asserted that the US will never default on its debt. The government itself does not directly print money, but it can, in theory, borrow an unlimited amount of money from the Federal Reserve. The Federal Reserve operates independently. Its mandate is to establish interest rates to achieve its policy objectives of 2% inflation and maximum employment. While it does not formally possess a directive to accommodate government budget deficits, in practice, that is precisely what occurs. The Fed's primary policy tool is the federal funds rate, which is the rate at which banks can borrow cash from one another for short durations, typically a few days at a time. Short-duration Treasury bills must trade at a yield comparable to the federal funds rate. If the yield on a Treasury bill maturing within the next couple of weeks were to trade at a significantly higher yield than the federal funds rate, banks would borrow at the federal funds rate to purchase the Treasury bill. This would increase demand for Treasury bills and drive up their price until the yield aligns with the federal funds rate. While the mechanism is somewhat complex, this effectively means the Treasury can issue an unlimited quantity of bonds because the Fed consistently acts as a backstop. Let's consider a hypothetical scenario. The Fed establishes the federal funds rate at 5%. This is the rate at which banks can lend and borrow money from each other for short periods. As previously explained, the yield on short-term Treasury bills must also be 5%, as banks are indifferent between lending to each other and lending to the government. As the government issues new Treasury bills, banks will acquire them. This action reduces the bank's cash reserves. The federal funds rate is determined by supply and demand. As the cash reserves within banks diminish, they will have less cash available to lend to one another, necessitating an increase in the federal funds rate. However, banks do not dictate the federal funds rate, the Fed does. As the Fed observes the federal funds rate creeping above its target, it will create new money and purchase bonds from the banks. This intervention will cause the cash reserves at banks to increase, providing them with the necessary funds to purchase the newly issued Treasury bills. Because the Fed can print an unlimited amount of money, the government can sell an unlimited quantity of Treasury bills, and they will always be able to sell them at or near the federal funds rate. The Federal Reserve does not directly loan money to the government, instead, it is channeled through commercial banks. However, the ultimate outcome remains identical. Let's revisit the credit card analogy. If your card has no spending limit, you can theoretically spend as much money as you desire and always borrow more to cover the interest. Your outstanding balance and interest expenses become irrelevant because you can perpetually secure additional funds. People struggle to grasp this concept because it sounds too good to be true. How can anyone, even the government, possibly borrow an infinite amount of money? It is absolutely true. All the commotion surrounding the debt ceiling is pure political theater. As long as Congress permits it, the government can borrow an unlimited sum of money and will never face bankruptcy. However, just because you can do something doesn't mean you should. Alan Greenspan is correct that the US will never default on its debt, but excessive spending still carries tangible consequences. There is no such thing as a free lunch. Every dollar the government spends is ultimately paid for by the populace. Yet, the method of payment is somewhat intricate. If the government borrows funds to construct a tank factory, it employs individuals and consumes resources. Had the tank factory not been built, these workers might have been engaged in producing refrigerators or washing machines. Because they are instead building tanks, the supply of refrigerators decreases, and their price increases. As another illustration, the enhanced unemployment insurance benefits provided during the pandemic were funded by government borrowing, ultimately financed by the Federal Reserve. People utilized these unemployment benefits to purchase groceries and other essential goods, despite not actively contributing to aggregate production at the time. This phenomenon also exerts upward pressure on prices. All of these factors are inflationary, and indeed, in 2021 and 2022, we witnessed consumer price inflation surge to as high as 9%. The Federal Reserve is an independent body with a mandate to reduce inflation to its 2% target. To achieve this, it was compelled to dramatically raise interest rates. The government is the largest borrower, but as we established earlier, it can borrow unlimited sums of money, so higher interest rates have no direct impact on its ability to finance its budget deficits. The burden of higher interest rates is exclusively borne by the private sector. For instance, prior to the pandemic, the average 30-year mortgage rate for a borrower with an impeccable credit score was approximately 4%. For a $200,000 home loan, this would have translated to a monthly payment of about $950. Now, mortgage rates have doubled to 8%. That same house would now cost you $1,500 per month. Consequently, you must either purchase a smaller home or reduce other expenditures to afford your increased mortgage payment. Moreover, nearly everything else you buy has become more expensive, a direct result of the high inflation experienced over the past couple of years. When you hear politicians lamenting that substantial government deficits are burdening future generations with an excessive debt load, they are mistaken. There will never be a bill coming due for future generations to settle. This is because we are already bearing the cost of government deficits today. Interest rates and consumer prices are significantly higher now than they would have been had the government not borrowed trillions of dollars during the pandemic. Your mortgage payments and grocery bills represent genuine expenses, just as real as the money the IRS deducts from your paycheck each month, even if it doesn't appear on your tax return. Even if the government persists in recklessly borrowing money, it will not culminate in a debt crisis. As long as the central bank maintains its independence, it will not trigger hyperinflation either. Instead, it will necessitate oppressively high interest rates, which will stifle private sector investment. If the government possesses the capacity to borrow an unlimited amount of money, you might wonder why we even bother paying taxes. The primary reason is that tax rates can be progressive. Most people agree that wealthier individuals should contribute a larger proportion of their income than a struggling low-income family. The cost of high interest rates, conversely, is distributed equally among everyone, regardless of their ability to pay. While government deficits are a real concern and should not be overlooked, the US will not find itself in a debt crisis, at least not in the foreseeable future. If we examine government debt crises in recent decades, they almost invariably stem from one of two causes, neither of which applies to the United States. For example, Greece experienced a catastrophic debt crisis between 2009 and 2018, leading to multiple defaults and severe austerity measures. Greece is a member of the Eurozone. They do not print their own currency, meaning their central bank cannot act as a backstop in the same way the Federal Reserve does for the US. Greece's government finances are far more comparable to those of a private sector company. They can indeed go bankrupt if investors deem them too risky and refuse to continue lending. Countries with their own currencies can also encounter debt problems. For instance, both Turkey and Argentina are currently grappling with extremely high inflation, soaring interest rates, and plummeting currencies. In both nations, the central banks lack sufficient independence. The governments were running substantial deficits. In such a scenario, the central bank should have raised interest rates to cool the private sector and effectively create room for the government's large expenditures. Instead, the government pressured the central bank to maintain low interest rates to stimulate the private sector, essentially attempting to have their cake and eat it too. The consequences were predictably disastrous. The situation in Argentina is even more severe. They also sought to finance budget deficits without burdening the private sector with high interest rates. Their approach involved issuing bonds denominated in US dollars. This influx of foreign currency allowed them to finance their debts without needing to increase their own currency supply, which would have necessitated higher interest rates to maintain stable inflation. The problem was, they had no realistic strategy for repaying their international creditors. They resorted to printing pesos to acquire dollars. This created a death spiral. As the peso depreciated, they needed to print even more pesos to cover their US dollar interest payments, which in turn caused further depreciation, and so on. The US finds itself in an entirely different position. Its central bank operates independently. The Federal Reserve has aggressively raised interest rates in the face of inflation exceeding its target. This proactive stance will prevent hyperinflation, regardless of how much money the government continues to borrow.